Okay, we're about to start the first learning module here for economics, firms, and market structures. And this is really a combined extract from two previous readings, a prerequisite reading and another reading in microeconomics from the previous year that was a required reading. And in extracting the contents from that reading, a lot of assumptions are made about how much you already know, and this jumps right into it right away. In fact, you are met with a bunch of curves almost instantly. And I find that if you've taken an economics course, a microeconomics course, you most likely did it early in your B school career. These really don't stick with you very long, that you've probably forgotten much of this, and it jumps right into it. So I think for this one here, it is far more important that we focus more on the pre-reads and a lot more explanation than what's available in this particular reading, because unless you know how these curves came to be, you're going to be lost. And I don't want you memorizing these things. There are just way too many curves to start memorizing. So what I've done is I've taken two of the readings and I put all of the screens on one timeline, and I've deleted those particular screens which are just not needed. So what you have in front of you is the combination of two prior readings that is now collapsed into this one learning module. But unless you really remember all of these curves, it's just going to be confusing and frustrating. So we're going to go through a lot more of the background material of how you got to these curves so that you can understand it. For those of you who have a very good understanding of micro, maybe you just finished micro, maybe it's still fresh in your head, watch it at 1.5 times speed. It's a great review, and by the time you get to the end, I guarantee you will have covered all of these learning objectives that are listed at the beginning of this particular reading. There's 5 of them. But in seeing 5, for instance, this last one over here is the combination of 2 learning objectives from the previous 2 readings. So these 5 really are the sum total of about 7 or 8 learning objectives. So if you go through this particular video, you will have everything in this particular reading. Okay. We're now on our 3rd of the prerequisite readings for micro, the last one as well. Here, we're going to be looking at the firm, and hopefully we can walk away from this one with the supply curve. In the last reading, we looked at the consumer. We got out of it with the demand curve. Now let's do the supply curve. The objective of the firm, straight up, maximize profit. In the last reading, the objective of the consumer was to maximize this thing called utility, this thing you couldn't see, feel, or touch. You just had to imagine this utility thing. Profit's a little bit more objective. So the objective is to maximize profit. Profit is total revenue minus total costs. And for total costs, it's a little bit different here. We're going to include the economic and the accounting costs. So let's break this down. Let's start with accounting profit. Total revenue minus accounting costs. These are the explicit costs of running a business. It also includes interest expense, where the economists then say, well, hang on a second, that's interesting. You're telling me, with your identity here, that assets equal liabilities plus owner's equity. And in your accounting profit, you're going to take a charge for debt, but no charge for equity. If you're going to include one of the costs of capital in your accounting costs, why not include the other? So the economics profession takes it a step further and says, well, let's calculate economic profit. That is accounting profit minus any total implicit opportunity costs. For most firms, the biggest opportunity cost is going to be the cost of equity, because you always could do something else with your money. So there'll be a charge for equity in right after, once we get to accounting profit. Then we will subtract whatever the required rate of return is times the dollar value of equity, and we should get our economic profit. Now I say the biggest opportunity cost is the required rate of return. You could think of a private business where the owner has left a job to run the business. Well, that's an opportunity cost. The opportunity cost of running that business is perhaps the $150,000 a year salary the person gave up because they left that to run their own business. So that would have to be included in to economic profit. All the implicit opportunity costs. If we have a situation where our economic profit equals zero, we refer to that as normal profit. That doesn't mean that the company is not making any money. It means that its accounting profit is just enough to cover off all of those opportunity costs, the big one being the required rate of return. So typically we simplify just by saying that economic profit is a situation where return on equity is exactly equal to the required rate of return. If our economic profit is greater than zero, in other words, our return on equity is greater than the required rate of return, we refer to that as abnormal or supernormal profits. And abnormal profits can be a result of two broad classes of characteristics. On one side, we have firm-specific characteristics, technology, efficiency, a cost advantage. This gives the firm a competitive advantage. If there's also government policy in place protecting the industry, if the firm also has monopoly power, or if there are significant barriers to entry, these structural or long-term characteristics will also give the firm a sustainable competitive advantage. All right, the last term we have to deal with in this learning objective is economic rent. And economic rent is going to look like abnormal profit, but it's not. When we say that a firm is generating abnormal profit, we say the firm is generating that abnormal profit because of something it is doing. When we say that the firm is generating economic rent, that is nothing that the firm is doing. It's just a situation the firm happens to be in where suddenly it gets a windfall. Things just happen. It's like, hey, look at this extra money we're making through no action of their own, though. And here's what we have to do. Let's look at the characteristics of the supply. And let's assume that for a particular good or service, that supply is fixed in the short run. So we'll have a vertical supply curve at a given level of quantity. Let's think of copper. There are a certain number of copper mines in the world, a certain amount of productive capacity, and if they were all producing at their productive capacity, they would produce a certain quantity of copper. And let's say that the demand for copper is D1, and here is the price, and there's an equilibrium price. And at that price, let's assume that economic profit equals zero. I'll just write EP equals zero at this point in time. Well, if we have a vertical supply curve, and supply is fixed in the short run, then demand completely determines the price. So let's say demand increases to D2, and here we are up here. The price increases to P2, and there we are there. At P2, we have economic rent equal to this, all of this, which is just the length times width, P2 minus P1 times Q. Well, this is not the firm's doing. This is simply demand increased for a product whose supply is very limited, the price went up, and all the firms in the industry benefit from this. So we refer to that as economic rent, that the firms are able to extract economic rent. It's more of a windfall than something that the firm worked for. Now, if it was something that the firm worked for, that allowed it to generate economic profit greater than zero, that we refer to as abnormal profit. This we simply refer to as economic rent. Any commodity, resource, or good that is fixed or nearly fixed in supply has the potential to generate economic rent. The more inelastic supply is, the higher the potential. By inelastic supply, that means even if the price even went higher, that even if the firms wanted to supply more, they simply couldn't. Think about how long it would take to say, well, for a copper mine to say, well, let's supply more copper. Well, that doesn't just happen tomorrow. There's a huge amount of investment and years of ramp up to build another mine or expand the current one you have before you can bring new supply online. So it simply doesn't respond to price changes. Let's look at the effect on equity value of different levels of economic profit. When economic profit equals zero, there is no effect on the value of equity because you are simply, as I said on the previous screen, returning to equity the required rate of return for holding that equity. When economic profit is greater than zero, there's a positive value to equity simply because you're adding value. Not only are they getting the required rate of return, but the return on equity is more than the required rate of return. And of course, if it's less than zero, it's a negative effect simply because the return on equity is now less than the required rate of return. So the price would have to drop such that the two would then equate together. All right, let's move on to LOSB, calculate and interpret and compare total, average, and marginal revenue. And let me make something very simple here for you now so that, that you don't, bang your head against the wall later on saying it doesn't make any sense. A firm sells many different products and many different services. We get that. But we're not talking about revenue at a firm level anymore. When we're talking about revenue, total revenue, average, and marginal, we're talking about a particular good that the company sells. So it may sell 5 products. Well, it's going to have 5 separate supply and demand curve dynamics. In one industry, it may have a supply curve that looks like this, and another like this. Another industry may look like this. There you go. There's different supply curves. And there may be different demand dynamics depending on what they're selling. So total revenue for the firm is the summation of all the different products at all the different prices that they sell. But when we're looking at what we're about to do here and the charts that we're about to draw out, we're really just saying, let's just take one of the goods that they sell and have a look at that. Because we're going to make a distinction between perfect competition and imperfect competition. Well, you may have a firm that sells products into both types of markets. You may have a firm that sells products in an industry characterized by imperfect competition, but also sells products or services in industries characterized by perfect competition. So we cannot generalize and say this firm is in that type of industry selling one of this type of product. So we usually break it down to just the particular good or service it's selling. Great. I just want to get that out of the way. Let's begin. Revenue, total revenue, average revenue, and marginal revenue. Well, total revenue is just price times quantity. How many did you sell? What did you sell them for? And that's TR. Average revenue would be, well, of everything that you sold, how much per unit? So we take our total revenue and divide it by quantity. But we just said total revenue is price times quantity. So it's price times quantity divided by quantity. Look what happens. What is average revenue? Price. That's it. Marginal revenue is the change in price times quantity, which is the change in total revenue, divided by the change in quantity. So if we let the change in quantity equal 1, what is marginal revenue going to settle out to? P. And that's it. So let's look at perfect competition and imperfect competition. First, in perfect competition, characteristics here, firms are price takers. All face a horizontal demand curve. What we're saying here is that every firm is so small that it can't possibly affect the price. Its supply is such a small amount of the overall market that if it makes double what it normally makes, it still won't affect the price. So they are price takers. So there's at a particular price, let's say P1, they can make a certain quantity. That's the price that they'll sell it at, because that's the price in the market. If they make more, they'll get the same price. If they make even more, they'll get the same price. So we can see in this particular case that price is going to equal our marginal revenue, because we said marginal revenue equals price, which is going to equal our average revenue, because we said here, these cancel out, average revenue equals price, which is our demand curve. So a firm selling in an industry characterized by perfect competition is facing a horizontal demand curve. It can sell all it can at the price in the market. It cannot affect the price. So if we look at total revenue at P1, here it is right here. It's just price times quantity. There's a particular price, times 1, times 2, times 3, times 4. So it'll just be a upward sloping line for total revenue. If the price were at P2, well, then you just have a steeper total revenue curve. Let's have a look at imperfect competition. First, the characteristics here. Individual firms can influence price. So suddenly quantity is going to matter. The more they produce, they will have an effect on price. There are a smaller number of firms in the market now, and when we get all the way to the limit where there's only one firm, we say that that is a monopoly. Since the firms can affect the price with their output, firms face downward sloping demand curves. Because over here in perfect competition, if the firm increases its quantity, it'll take the same price. It can't affect the price because it's too small. Here, they're large enough that if they increase their quantity, they can get into a situation of oversupply, which will force the price down. So they will be facing downward sloping demand curves instead of horizontal demand curves. Let's see how this dynamic changes. All right, so here we are in a situation of imperfect competition. Let's have a look at our total revenue first. Let's make sure we understand what's going on here. So here we are. Quantity begins to increase and total revenue begins to increase to a maximum of some point, and then total revenue starts to drop. Well, how can this possibly be? Well, let's draw out a downward sloping demand curve. And we said since they can influence price, they're facing a downward sloping demand curve. Well, we can see that if we have a price here, and we have a quantity here, there is your total revenue. But if the price is way down here, well, there's your total revenue. At some point along this curve, this rectangle will start to shrink. That's represented by this curve. The more quantity you put on the market, you will start to affect the price. The price will become lower. The combination of price times quantity will reach some maximum point and then start to roll over. That's all it's saying. The point at which it rolls over is where marginal revenue equals 0. That means if we're selling 10,000 units, or let's say 1,000 units, at $10 a unit, we'll have $10,000 in revenue. If we then sell 1,001 unit, there'll be a new price. We don't know what it is, but that new price will also result in the combination of quantity times price equaling $10,000. In other words, adding one more unit added nothing to revenue, so that the marginal revenue equals 0. It is at that point where total revenue is maximized. So down here, in this bottom chart here, there's our quantity, here's our revenue again. We can draw our marginal revenue curve as a downward sloping curve where it hits 0. Down here is a 0 for revenue. Where it hits 0 is where revenue, total revenue, hits a maximum. So there's our marginal revenue curve. Well, what is this over here? This is our average revenue, not our marginal, but our average. So at every point here, we would take, well, here's our total revenue divided by the quantity. There it is. Total revenue divided by the quantity. There it is. So we have total revenue up here. We have this quantity. Clearly, we're going to have positive average revenue, right? Marginal revenue is 0, but average revenue will be greater. Hence this statement here, that average revenue is greater than marginal revenue at all points when we're drawing this out. And eventually, it will hit 0 because if we go low enough in price, it'll be free. We'll give away a lot of stuff, but we'll have no revenue. So our average revenue will be 0 at that point in time. Well, this over here, from this point to this point, there's your demand curve. That is the demand curve that this firm faces in this particular market for this particular good, is the average revenue curve. So price equals average revenue equals our demand curve. And average revenue is nothing more than total revenue over quantity, which equals our price. Because remember, total revenue is what? Price times quantity, and that's quantity, which equals price. All right, LOSD, calculate and interpret total, average, marginal, fixed and variable costs. So everything we're doing now is about costs. We've gone through revenues. We've looked at our factors of production. Now we're going to talk about costs. And just a little word of warning here. It is this in this learning objective where students just get lost because there just seems to be so much going on. There's all these different curves and they all mean different things, and they tend to get lost. And it's actually quite simple. If we just take the curves out of the equation, close our eyes, and just think about what's going on, we can figure it out. It's drawing all the curves that sometimes throw us off. So you might want to spend a little bit more time on this learning objective than the others, because if you sort of get lost here, everything else that follows is sort of confusing. You have to sort of memorize everything after. So let's try to get our understanding down here. Okay, so we've got costs. And as you know, every business faces two broad types of costs: fixed costs and variable costs. Let's deal with our fixed cost first. Our cost of capital, both for debt and equity, is in our fixed cost. We mentioned economic costs before, and we said we're going to include those implicit opportunity costs in. Well, that's in the fixed cost component, just so that we know that. So there are two types of fixed costs that we can talk about: our total fixed costs and our average fixed costs. Total fixed costs is just, well, how much do you spend a year on fixed costs, or in any given period? What's the sum of money? That's simple enough. Our average fixed cost changes with our level of output because it's average. So if our fixed costs are $1 million and we're outputting 1,000 units, our fixed cost per unit is 1,000. The more output we make, the lower our fixed cost per unit goes because it's fixed. So our numerator would be our fixed cost, our denominator would be Q, and as Q increases, our average fixed cost decreases. So let's just stop right there and come on down to these two bottom graphs. Let's make sure we understand where our fixed costs are. If we're going to graph out the total fixed cost, here's our cost on the vertical, here's our quantity of output on the horizontal, it would simply just be a straight line. Why? Because it's fixed. no matter what quantity of output we have, we would have the same total fixed cost. Over here now, this is cost per unit. This is total cost, this is cost per unit, and again, this is quantity. As our quantity increases, look what happens to our fixed cost. It decreases at each stage. At every Q we add, we're taking a fixed cost component and dividing it by a larger and larger Q. Our average fixed costs simply just drop. Great. Can I put a check mark here? We understand fixed costs include both explicit and implicit costs. We get the concept of total fixed cost ends up being just a straight line across all the quantity that we're putting out for total cost. And our average cost is just divided by Q. It will be a downward sloping line throughout. The further we go, the lower and lower and lower it gets. Great, let's move on to variable cost. Notice we have no marginal fixed cost because they're fixed. There is no marginal fixed cost. There's no concept of it because it's just fixed. Let's go to variable costs now. Our total variable costs are our variable cost per unit times the amount of quantity. So if we spend $6 per unit to make each unit and we have 1,000 units, it's $6,000. It's variable with the quantity. So we know we're going to multiply something with quantity, and it's the variable cost per unit times quantity. That'll give us total variable cost. Well, if we take total variable cost and divide it by quantity, we'll get average variable cost. Well, look at what total variable cost is. Let's just go out here in the margins here and do it here. We have variable cost per unit times quantity divided by quantity. Take that off, what are we going to end up with? Variable cost per unit. So our average variable cost is simply just our variable cost per unit. All right, let's take that downstairs and look at the graphs what we have. Let's start at the first one over here where we are representing total cost. Here's our cost, here's our quantity. Here's our total variable cost curve. If we have no output, no quantity at all, what's the total variable cost that we're going to have? 0. We're not making anything. As we add quantity, we add variable costs. So it simply just increases. It's just our variable cost per unit multiplied by Q, so up we go. Now that's not entirely correct, but for what we're doing here, this is sufficient just to show a relationship here. Typically, it would be there'd be more curvature to this line representing a period where we have economies of scale and then a period where we have diseconomies of scale. We don't need to capture it here. We're going to capture that concept over here when we look at average variable costs. So here we are. At low levels of output, we would have an average variable cost per unit that is high and dropping as we add quantity, because we're getting economies of scale. We're buying at a lower price per unit because we're buying in quantity now. Maybe we're getting more specialization out of our labor. We're getting more efficiency out of the production process. That'll continue to some point, beyond which it would be hard to get our average variable cost per unit much lower, but diseconomies of scale would now begin to work against us, and we might actually start to see our average variable cost per unit increase as we try to squeeze more and more production out of a given amount of capital. So we would start to see it increase over time. Notice that we don't draw it right to the origin here because there is a bit of a disjoint here. At 0 cost, if we have a 0 output, if Q equals 0, our fixed cost would go right up to the origin, almost to the point where it's 0, because you can't have an average fixed cost with 0 output. So that's why we have this gap. Same with the average variable cost. You need at least one unit to have average variable cost. So that's why we don't draw these all the way to the origin like we do over here. We draw these all the way, but we don't draw these. Okay, if we get the idea behind total fixed cost and total variable cost, and we get the idea behind average fixed cost and average variable cost, moving to total cost is quite simple. All we do is we add the two together. So our total cost curve would start where total fixed cost begins, because at 0 output, we still have our total fixed cost. And then just the distance between here is constant all the way through. We're just taking this curve and adding it to the first curve. Same with here. This distance over here is added to this curve to get the total all the way through. Now notice how this distance is shrinking because our average fixed cost is shrinking. So over here, this distance here is this distance over here. So our average total cost is just the sum of the two curves, or up here for total costs. Total costs are total fixed cost plus total variable cost. And average total costs are just total cost divided by quantity. And here is where we introduce the term marginal cost. It is the change in total cost for the change in quantity. And we're going to see what relationships these play shortly. So over here, there's one more thing we got to talk about, which is the 2 points on these two curves. Notice that they have minimums in two different places. We will hit a minimum on the average variable cost curve before we hit a minimum on the average total cost curve. So point Q, AVC, is at a minimum, but since average fixed costs will continue to decline, this point, QATC, represents total minimum cost point. That is, it's the minimum cost per unit, happens on the average total cost curve, not the average variable cost curve. These 2 points are going to become important very shortly, so you must recognize that relationship. Average variable costs will bottom out before average total costs will bottom out, because average fixed costs will still be decreasing as we increase our quantity. All right, let's bring some of these things together here. Have a look at this graph that I have up here. This is representing perfect competition in the short run. And on our vertical, we've got our cost per unit, but it also maps onto our revenue per unit and our price. Because remember, under perfect competition, if you just jump way down here for a minute, we said that price was equal to our average revenue, was equal to our marginal revenue, and we're also going to show that it equals our average total cost. But we're jumping ahead here. I just want to make sure that you understand the layout of the chart here. Here's our average variable costs. Here is our average total costs. And this is interesting. Here is our marginal cost curve. Notice that the marginal cost curve intersects the average variable cost curve at its minimum, and that point we'll label S. It has a meaning. And it intersects the average total cost curve at its minimum as well, and that point has a meaning. We'll label it T. And just so that we have some idea of the relationship between average variable cost and marginal cost, let me draw just a few small curves for you, and I'll just draw them in the middle here, and I will delete them. Let's do this. If we have a situation where we have our average costs decreasing, that signifies that we have increasing returns to scale. We will have a situation where our marginal cost will be below the average cost curve. All right, so there's our average cost, there's our marginal cost. That is displaying increasing returns to scale. Let me back out of that and draw it differently now. Let's show a situation where we have decreasing returns to scale. We would have our average costs increasing, and our marginal costs at this point would be above the average cost curve, and that would signify decreasing returns to scale. So let me get rid of that stuff here, and let's look at what we have here. Look at this first part of the average variable cost curve. It is decreasing. So the marginal cost curve is below the average variable cost curve as long as it's decreasing. It will intersect the average variable cost curve at its minimum, and when the average variable cost curve is increasing, the marginal cost curve is above it. This is a period, or this is during this quantity, this is increasing returns to scale, and this increasing average variable cost curve represents decreasing returns to scale. And we can make the same argument with average total costs, as long as we get that relationship for marginal costs. If average variable costs are decreasing, the marginal cost curve will be below the average variable cost curve. And if average variable cost curves are increasing, the marginal cost curve will be greater or above the average variable cost curve. And the marginal cost curve intersects both AVC and ATC at their minimums. Great. Let's look at this part of the marginal cost curve that I've made much darker than the rest. That is the firm's supply curve. And I'm going to prove to you that that is the supply curve by looking at 3 regions on this chart. We're going to look at what happens when we have a price equal to 1, P equal to 2, and price equal to 3. So at P1, what is going on here? At P1, the firm is not covering its variable cost per unit. The price is down here. This is the average variable cost per unit curve, and notice the price is below the curve at all points. So that means that the firm would be better off not making anything and just paying its fixed costs, because every time it sells something, it's getting a selling price less than its cost. Its average revenue is less than its average variable cost, in which case you do better by doing nothing. So below point S, accounting profit is less than zero. We're losing money. We know that. Our accounting profit is less than zero. And on the chart down here, if we're below S in the short run, we should just shut down. We should just not make anything. In the long run, if we can't fix that situation, we should just leave the industry altogether. So that's what S is. S is called the shutdown point. Below S, we shouldn't make anything. Let's look at the point between S and T. And I got a price P2 in there. Let's look at what's going on at P2. Our variable cost per unit is being covered, but our total cost per unit is not. Well, what are we going to do in this situation? In this situation, our accounting profit, we can't really say whether it's positive or negative at this point, but we can say this: our accounting profit is less than our required rate of return. Even if it was positive, it would be less than our required rate of return. Should we continue to operate? Let's have a look over here. If we're between S to T in the short run, yes, continue to produce. Why? Because our variable cost per unit is being covered, so we must be making something on each item, and that something is called the contribution margin. At least we're helping to pay some of the fixed costs. Maybe not all of them, but at least we're paying some of them, so we should continue to produce. But in the long run, if we can't fix that situation, we should just leave. Let's look at point T, and let's just imagine there is a price. I didn't put it in, but let's just put a price right now at point T. We'll call that price PT. What happens at point T? Well, here our marginal cost curve equals our average total cost curve. And because we can also chart, because we're talking about perfect competition, it's revenue per unit on here, we can see that our price, which we know equals our average revenue, which equals our marginal revenue, now equals our average total cost per unit. So total revenue at this point equals total costs. And remember, our costs include even those explicit costs, right? Total revenue equals total costs, which means our return on equity equals our required rate of return. Our average total cost is equal to our marginal revenue, is equal to our average revenue, is equal to our price, which we say up here. Above T, accounting profit is greater than the required rate of return. So at above T, what should we do in the short run? Produce. What should we do in the long run? Stay in the industry. So that's what we do at T. Anything above, all costs are being covered and then some, where the firm is generating supernormal profits or abnormal profits. At point T, the firm is generating a normal profit. That is called the economic break-even point. When economic profit equals zero, well, that's an economic break-even point. We've covered all our costs, including our required rate of return. So the big takeaway here is this. This is the firm's supply curve. It is the firm's supply curve because below S, you shouldn't make anything. You should produce zero quantity because you're losing money on every unit you produce. And anything above S, you're at least offsetting your fixed costs, so you may as well produce for as long as you can until you decide to leave. And above T, well, you're in the money. LOSG has keyword describe how economies of scale and diseconomies of scale affect costs. And before we do, let's make a distinction between the short run and the long run. The short run is the period of time where at least one of the factors of production are fixed, whether it be technology, plant size, the size of the labor force, etc. But one of the factors of production are fixed. In the long run, all are variable. So that would vary by industry. This gives rise to short run average total cost curves and long run average total cost curves. So let's deal with the short run average total cost curve first. I've drawn a whole bunch of them out here, and this looks like a complicated chart here. Let's just focus on the first one over here. This is when we first enter an industry, or when a firm first enters an industry. It sets up shop, and as it expands its output, it can drive its costs down to a certain point, beyond which it starts to increase its costs. And perhaps it invests in some new technology or a larger plant size, and it finds itself on a new short-run average total cost curve, which is SRATC2. And it continues on until it hits some minimum, and then it finds that, well, you know what, our costs are starting to decrease now. We need another investment. So it continues on by making these investments in new technology, new plant size, etc. So it keeps shifting to new short-run average total cost curves. Well, at some point, further investment isn't going to help. And we see that each successive round of investment doesn't seem to get its costs below a certain point. Its costs at all parts of the curve start to increase. Well, if you combine all of these short-run cost curves together, you could imagine a whole bunch more in there. I've just drawn out 4. But the thicker purple line here draws out the long-run average total cost curve. And if you want to make it a little bit smoother, there it is right there. There's your long-run average total cost curve. So at some point, we hit a minimum point among all the curves on short-run ATC4. So up to that point, this company is experiencing economies of scale. We have increasing returns to scale. Because as we scale up and hit a new short-term cost curve, we keep decreasing our costs. Beyond there, we're experiencing diseconomies of scale, decreasing returns to scale. Now, you'll recall we are dealing with perfect competition here. The firm is a price taker. So let's put a price in here at P1, and we'll put P1 low enough that it intersects SRATC4 at its minimum. Here's the deal with something like this. If you're going to enter this industry with this price, and this industry is characterized by perfect competition, you have to enter on that cost curve. You can't start up here and slowly work your way down. You have to enter at that cost curve. That is called the minimum efficient scale required to enter this particular industry. At P1, firms must produce at SRATC4, short run average total cost curve 4, or exit. Well, we have a couple of short lists here for economies of scale and diseconomies of scale, things that contribute to it. Under economies of scale, division of labor, division of management, oversight, specialization, productivity enhancing equipment or productivity enhancing technology, efficiency gains, whether it be waste reduction in the production process, energy reduction, superior market insight. Maybe you just are better, or a firm is better at forecasting. Volume discounts. For diseconomies of scale, poor management control or oversight, overlap or duplication of functions, greater stress on local supply markets. We can think of labor markets. If you're in a particular region where you just can't get the talent, you've pretty much exhausted the current labor supply, and you have to look further and further away, and you also have to pay more. Plus, as the bigger you get, the bigger target you are for unions, for antitrust legislation, for litigation. Let's look at 3 different curves at the bottom here, just in case we're thinking that, well, all industries experience economies of scale to a point and then diseconomies of scale. That may not necessarily be true. Some industries may be characterized by a curve that looks like this, where there are rapid economies of scale up to a certain point in size and then rapid diseconomies of scale. Others may not experience any diseconomies to scale. So the larger they get, the more economies of scale accrue to them. And then others may have constant returns to scale. So between, let's say, this point and this point, as they're adding size, they're realizing constant returns. There's no increasing or diminishing economies of scale here. We're now on LOSH. Keyword here is to distinguish between short run and long run profit maximization. And we'll deal with the short run first, but let's recall a few things. We are dealing with perfect competition, hence the firm is a price taker. In those situations, price equals the firm's marginal revenue, and the condition of marginal revenue equaling marginal cost, we've already discovered that that is a point of maximum profit, or if you're losing money, it's also the point of minimum loss in the short run. So let's deal with the short run. Let's draw out a short run average total cost curve, and there it is right there, that nice big smile across the chart. And our marginal cost curve intersects the average total cost curve from below at its minimum point. As the average total cost curve is decreasing, the marginal cost curve is below. As the average total cost curve is increasing, our marginal cost curve is above. All right, let's set a price P1 and let's draw it straight across. Remember now, price equals marginal revenue. So at point 1, that is the point where marginal revenue equals marginal cost. So let's look at what's going on at point 1. MR1 equals MC at point 1. That is a point of maximum profit. That is one of the conditions of maximum profit. And since our marginal revenue line is above the average total cost line, we know that we have an economic profit. We have an economic profit equal to A. Well, this encourages market entry because the return on equity is greater than the required rate of return. There's excess profit. There's abnormal profit here. So that'll put downward pressure on P1. Let's start at a different place. Let's start at a price that is below the intersection of the average total cost curve and the marginal cost curve. We'll set a price at P2. Again, P2 is equal to our marginal revenue. So at P2, marginal revenue 2 equals marginal cost. There we are right there. So that should be a point of either maximum profit or loss minimization. Well, we can easily see that our marginal revenue is below our average total cost. We must be in a loss situation, and we are. We're at a minimum loss, but we're still losing money. This encourages market exit since the return on equity is less than the required rate of return. So we can see that when the price is above the average total cost curve, there is downward pressure on prices. When the price is below the average total cost curve, there is upward pressure on prices. We get downward pressure on prices through more firms entering the industry, more supply coming onto the market. And we get upward price pressure from point 2 upwards because firms are leaving the industry and taking supply off the market. There's the short run done. Let's look at the long run. And we're going to see the long run is nothing but a series of short run adjustments. All right, let's focus on the long run now. Here is our long run average total cost curve. And we're going to start up here on short run average total cost curve 1. Here is our marginal cost curve. We're at point 1 right here at price 1. At P1, our marginal revenue equals our marginal cost on SRATC1 at point 1. Just to let you know where we are, we're right here. At that point, there is zero economic profit because all the lines are intersecting. Our marginal revenue is equaling our marginal cost. We're on the SRATC curve, so zero economic profit. The firm decides, you know what, we think we can do better than this. Let's invest in some new technology, some new processes, some better machinery, and we can move ourselves down to SRATC2. So they do that. There's our new marginal cost curve. Now the price is still at P1, so now we're at point 2 over here. So the firm invests and moves to SRATC2 at point 2. And at this point, MR1, marginal revenue, because we're still on the same P1, same price, marginal revenue 1 now equals marginal cost curve 2. So we're at that point there. We have economic profit. Economic profit equal to this distance over here, all the way down to the point where we hit the short run average total cost curve. Well, what's this going to do? We've already seen that in the short run, that's going to encourage firms to enter the industry. That's going to put downward pressure on prices. Prices will move down this way, P1 to P2, until we come to point 3. So at P2, marginal revenue 2 equals marginal cost 2 on short run average total cost curve 2 at point 3. Economic profit is 0. So we can see that if we start off on SRATC1, and let's assume that there were multiple steps on the way to SRATC2, that every time we draw out a new curve and a new marginal curve, here we are, pressure comes in to push the price down to here, we decide to invest again, there's our marginal cost curve, we're now intersecting up here, prices, firms enter, push the price back down. So the long run average total cost curve is drawn out from a series, as we've seen these, a series of short-term curves where prices will continue to drop until we'll get to a point where any further investment cannot possibly help our average total cost curve situation. We're at a minimum, a long-run average total cost minimum, and we've settled at a price that results in economic profit being equal to 0. Okay, we're on the firm and market structures. And our first learning objective, describe characteristics of perfect competition, monopolistic competition, oligopoly, and pure monopoly. So we're going to look at 4 market structures along 5 dimensions, and these are factors that determine the market structure. If you're familiar with Porter's 5 forces model, you're going to see a lot of similarity along these 5 dimensions. So let's, what we're going to do here, instead of moving across the 4 structures for each of the characteristics, I'm going to just spend my time on perfect competition for each one, then we'll move to the next one, etc. So let's start with perfect competition. Number 1, the number and relative size of firms. There are many firms, and I should add to this, it's not just that there are many firms, it's that no one firm has any significant control of the market. Typically, we say that out of all these many firms, there is not one single firm with more than 10% of the market. So the majority of them, all of them, have less than 10% of the market, which means no one firm is big enough to move the price. The degree of product differentiation in perfect competition, you have homogeneous products, very standardized products. This is typical of most commodity markets. Seller power over pricing decisions, well, you have none. No one's big enough. And because there is standardization of the product, think about it in terms of soybean. My soybean versus your soybean. Well, it's hard to differentiate between the two. And if we can't differentiate, I can't say that mine is any better than yours. Neither one of us has pricing power. Barriers to entry or exit, very low. Degree of non-price competition, none. We basically compete on the basis of price. We are price takers. Let's move over to monopolistic competition. Number and relative size of firms, there are still many firms here. However, you may have some firms that have more than 10% of the market at this point, but you still have many firms. The degree of product differentiation, now you're moving away from homogeneous or standardized products to differentiated products. So we can think of clothing. For example, if you walk into any mall, how many clothing stores are there? All with different brands, all with different types of clothing, all targeting different segments of the population. Again, many players, differentiated product. Seller power over pricing decisions. You have some power, and that power pretty much comes from a brand. We'll stick with clothing on this example, so that if you have a brand, you have some pricing power. Barriers to entry or exit, they're still very low. The degree of non-price competition, if there is going to be competition not based on price, where is it based? Well, advertising and product differentiation. Let's move to oligopoly. Number and relative size of firms, we have few. So we can think a good example here is airlines. Another good example would be beer companies, especially the large consumer beer companies, not the craft beers, but the larger ones. The degree of product differentiation, homogeneous and standardized. Think of the last time you took a flight. We don't fly on brands. We just fly routes. I want to go from this city to that city at this particular time. I want no stopovers. I want to fly out at this time and land at So we just go on to Priceline.com and we find the flight that best suits us. We look at the airline after, okay, what counter am I going to when I get to the airport? American, Delta, which one? We don't really care about the brand. So we have an airline, a flight is very homogeneous and standardized. Seller power over pricing decisions. There is some power to considerable power. Barriers to entry or exit are very high. That's why there's only a few players in the industry. Degree of non-price competition, advertising, and product differentiation. One airline might advertise that they have bigger seats, more leg room, and friendlier staff. Finally, we have monopoly. Number and relative size of firms, there's only one. Well, mono, right? That's the definition of monopoly. Degree of product differentiation, it is a unique product. Seller power over the pricing decision, considerable power. Barriers to entry or exit are very high. If they weren't very high, you wouldn't have one firm, you wouldn't have a monopoly. You'd start to move towards oligopoly. Degree of non-price competition. Well, we don't have to worry too much about product differentiation. It is a unique product, so by definition, there is nothing to compare it with. We wouldn't even look at that. We basically have just advertising. All right, we're on our next learning objective, LOSB. Explain relationships between price, marginal revenue, marginal cost, economic profit, and the elasticity of demand under each market structure. We're going to start by comparing perfect competition with monopolistic competition along some dimensions. We're going to start first with demand analysis. We'll look at supply analysis, etc. So let's start with demand, and we'll start with perfect competition, which we have seen. We've seen this in the third reading in the prerequisite readings for microeconomics. That was the theory of the firm, where we really spent a lot of time on perfect competition. We've also seen it in the first reading of the economics series, where it was just a summary of the three prerequisite readings. So I'm not going to spend a lot of time laying out the argument for perfect competition and why the curves look the way they do. This should really just be a reminder at this point. So let's draw out our demand curve for perfect competition. We know that the firm, as we see along the bottom, the firm is a price taker. Prices are industry determined. So what we get is we get a horizontal demand curve. So our price will also equal our marginal revenue, which will equal our average revenue, which is our demand curve. And our demand curve is infinitely elastic. What does that mean if we say it's infinitely elastic? Infinitely elastic. It means that if we know what elasticity is, the percentage change in quantity for a percentage change in price. If prices just changes either a little up or a little down, what happens to quantity demanded? It just disappears, period, because the price is industry determined, not firm determined. If we have a horizontal demand curve, that means our total revenue curve is really just a function of quantity. We'll sell all that we can at that particular price. So as we sell more and more, our total revenue curve simply continues to increase. If we go from perfect competition to monopolistic competition, all we're doing is we're saying, okay, well, let's add a differentiated product now. Let's add some non-price competition. That will give us some pricing power. And if a firm has pricing power, that means the quantity that it puts on the market will affect the price. So what we have is a downward sloping demand curve. And if we have a downward sloping demand curve, our total revenue will be a different function. Simply because at some point, since total revenue is price times quantity, at some point as the price begins to drop and quantity continues to increase, there'll come a point where price times quantity actually begins to shrink. So our total revenue curve, you're kind of seeing how the magic is done here, right? Our total revenue curve takes on an inverted U shape. Now that is it's an exaggeration, but it's to make a point. There's our total revenue curve. And if we look at the peak of the total revenue curve, it has a relationship with marginal revenue. At the peak of the total revenue curve, what do you think marginal revenue is? Marginal revenue is the derivative of the total revenue curve with respect to quantity. So at a peak, we have a slope that is 0. So the first derivative should be 0. And so our marginal revenue curve will intersect, if we draw our marginal revenue curve down here, let's take it from here to here. There is our marginal revenue curve. And of course, it can go negative because as soon as we hit the peak, as soon as we roll over the peak of total revenue, our marginal revenue does become negative. So we can show it becoming negative. And our demand curve should also intersect quantity where total revenue equals 0. Because if we lower our price enough so that everything is free, sure, we'll move a lot of product, but we'll have 0 total revenue. So our demand curve is downward sloping as follows. And of course, this point lines up with this point. Our demand curve is also our average revenue curve, which is our demand curve here. And this is our marginal revenue curve. And the relationship here is that the marginal revenue curve will have a slope that is twice the slope of the demand curve. I'll prove that on the next screen. Okay, for the inquiring minds out there, let's start with our quantity function. It is equal to some intercept minus a coefficient on price. Let's isolate price to one side. You will get the form, if you follow the algebra through, minus Q over B. And we can see that our slope here is basically a negative 1 over B. Great. Let's write out our function for total revenue. We know that total revenue is price times quantity. Well, let's substitute price in here. We have A over B minus Q over B. multiplied by Q. If we expand that out, we'll have A over B multiplied by Q minus Q squared over B. And we know that a marginal revenue is just the change in revenue for a change in quantity, which is really just the derivative of total revenue with respect to quantity. So let's take the first derivative. While this disappears, and you are left with A over B minus, and we bring this down to Q over B, noticing that the slope down here is negative 2 over B. Notice it's negative 1 over B, negative 2 over B. Let's put our conclusion in there for the slope of the marginal revenue curve equals 2 times the slope of the demand curve, right? That's why we draw the demand curve like this. If we have that, and our marginal revenue curve has a slope that is twice as steep. That's it. Okay, let's compare perfect competition and monopolistic competition in terms of supply analysis. And here we'll attempt to draw out the supply curve. For perfect competition, you will recall the average variable cost curve looked like this with a minimum point. The average total cost curve looked like this with a minimum point here. And the marginal cost curve intersected both of them at a minimum, marginal cost. And we had certain points that meant something. This point over here we called our shutdown point. So that is our shutdown point. And this point over here is our economic break-even. This segment of the marginal cost curve is return on equity being greater than the required rate of return. And let's see if I can get a proper pen to do this. I need one that makes a big smudge. There we are. Right here is the firm's supply curve. So the marginal cost schedule determines what the supply curve is. Under the shutdown point, we would not produce anything, simply because the price that we would get, and remember with perfect competition, our price is our marginal revenue, and we would maximize our profit where our marginal revenue equaled our marginal cost. If we were down here, we can see we're not even covering our variable costs. It would be better for us not to make anything and just pay the fixed costs than to lose money on everything we sell. So below the shutdown point, quantity produced will be 0, and above the shutdown point, quantity produced will be positive. Hence, there is our supply curve. The level of output is determined by the marginal cost schedule. And we know that our marginal revenue curve, where our marginal revenue curve equals our marginal cost curve, is where we either maximize our profit or minimize our loss. So let's say that the price was here. We just move our price across over to here. There's the marginal cost schedule, and that would dictate that our output should be right there. Let's go over to monopolistic competition. Here we have no well-defined supply curve. Simply because at every price or every quantity that we choose to produce, there is a different price. So we would have to select multiple different quantities and draw out multiple different prices, and from there connect all those dots, and we would get a supply curve. So that's why we say there's no well-defined supply curve like we have in perfect competition. But we can still say something. So let's draw out our marginal revenue curve. Marginal revenue curve. Let's draw out our demand curve, which has half the slope, and it's also our average revenue curve. And we have some curves to draw in here as well. We have our average total cost curve. Let's say it looks like this, average total cost. There's our minimum point right there, so we know that our marginal cost curve will intersect the average total cost curve at a minimum. And look what we have. We have a situation where marginal cost equals marginal revenue. This is our marginal revenue curve here, right? And that is the point right here that determines the level of output that we're going to produce. So if we draw this down here, and let's move it all the way up to the demand curve, you're going to see what we're going to do here. This is the output that we're going to determine. So the level of output is determined at the point where marginal revenue equals marginal cost. However, the price is not determined by marginal revenue as it is in perfect competition. In perfect competition, our price is our marginal revenue, is our average revenue. The price, if I could just get this to say straight, there we go. Our price is determined by the demand curve. There's our price. So we would output this quantity at that price. Now to draw out our supply curve, we would then have to change our price and determine what quantity is associated with that and plot another point and just keep doing it for each price, and we would then draw out a supply curve. But just from the curves alone, there is no well-defined supply curve as we have in perfect competition. So the level of output is determined at the point where marginal revenue equals marginal cost, but price is determined by the demand curve. Well, let's move on and compare optimal price and output for both perfect competition and monopolistic competition. Let's start with perfect competition. Let's get our demand curve up, which is also our level of price in the industry. This is also our marginal revenue, which is also equal to our average revenue. And let's put, we're going to put a couple of cost curves up. How does that sound? Let's put the first one up right on the line. There's our average total cost, but we're going to also add two more, all right, just to show you something here. So there's another average total cost curve, and we'll add one above. So there's three average total cost curves. So we'll label this one ATC, and our bottom one we'll label ATC, oh, this one here, there we go, ATC1, ATC2. And we're going to have to draw out three marginal cost curves, but the first one we'll use the first ATC curve we drew out. We know that our marginal cost curve intersects the average total cost curve at a minimum. And our optimal output is where marginal revenue intersects marginal cost. Well, it'll intersect right there, right at the very bottom, the minimum of the average total cost curve. We're going to see on the next screen that that is a long run point for perfect competition, but it doesn't have to be. So if we're looking for optimal output, it would be at the point where marginal cost equals marginal revenue. And there would be our optimal output. It just so happens at this particular point, when we're calculating our profit, our total revenue minus our total cost, because we're just intersecting the average total cost curve, our marginal revenue equals our marginal cost, which equals our total cost. So total revenue minus total cost gives us our economic profit. In the ATC case here, economic profit is equal to 0. Let's move down to ATC2. So we've managed to lower our costs, let's say. So our optimal output, I'll get another color out, there is our minimum for the average total cost curve. We would draw out a marginal cost curve as follows. Here now would be our optimal output. This is where our marginal cost curve meets our marginal revenue curve, and the difference between here gives us an economic profit greater than 0. So let's write that in. Our economic profit, in this case, will be greater than 0. Well, what will this do? If we have economic profit greater than 0 and we can compete on that cost curve, well, that will attract new entrants into the industry as well. Let's move up to the other cost curve here, ATC1. And let's just assume that this marginal cost curve is actually intersecting the minimum. We'd be back at this point here on marginal revenue and marginal cost as our optimal output. If we extend it up to here, notice that it is below our average total cost. So in a case like this, we would be facing economic profit less than 0. Economic profit here is now less than 0. In the short run, as long as it's greater than our average variable cost, we would continue to produce, but in the long run, we would shut down. So the optimal output would still be where our marginal revenue equals our marginal cost, but instead of maximizing profit at this point, we would say that we are minimizing our loss. If this point, this quantity, is such that at that price, we're producing below our average variable costs, then we would just simply not produce anything, and our optimal output would suddenly jump all the way to 0. So there'd be a gap that we wouldn't decline slowly if this economic loss is such that it is less than our average variable cost. Our quantity would jump all the way to zero. Let's look at it in terms of monopolistic competition. And again, we need our curves here. We're going to need a marginal revenue curve. So we'll draw that out. Our average revenue curve, or our demand curve, will have a slope as follows. So that is our demand curve. There's our marginal revenue curve. Now we need some cost curves. So there is an average total cost curve. Where's the minimum over here? And there's our marginal cost curve. And the optimal output is at the point where the marginal cost curve intersects the marginal revenue curve. So let's try to be neat about this, and we'll draw some straight lines if we can. And there is our optimal output at that point. We've seen what I'm doing here. We've already seen before, but I'm just going to add another amount to it because we're trying to figure out profit here. Let's go to right here. Notice that at this quantity, this is where we hit the total cost curve, the average total cost curve. So we'll say that this is the price that we sell at. This is the cost that we incur in producing that output. So total revenue will be P times Q will be all of this. That's total revenue there. Total costs are all of this. So our total revenue is price times quantity. Total cost is cost times quantity. So we can see that our profit will be total revenue, the larger rectangle, minus the smaller rectangle. We have economic profit greater than zero. All right, well, let's have a look at the long-run equilibrium for perfect competition versus monopolistic competition. And we've already seen the long-run equilibrium on the previous screen when we looked at optimal output. And long-run equilibrium occurs where economic profit equals zero. And that is because if there is positive economic profit, it encourages firms to enter the industry, increasing supply. And if there is negative economic profit, it encourages firms to exit the industry, thereby increasing supply. So in the long run, it's still the marginal cost and marginal revenue intersection point will still determine optimal output. But now firms will be operating at the minimum point of the average total cost curve. That's called minimum efficient scale. It's either you operate there or you leave the industry. So that is where economic profit will equal zero. Horizontal demand curve, profit maximization when marginal revenue equals marginal cost. But in this situation, we also have the situation where it also equals price equals average cost. For monopolistic competition, we can make the same argument. Economic profit greater than zero will encourage firm entry. As more firms enter the industry, they start to take customers away from existing firms in the industry. The demand for every company's products will drop because as more suppliers come into the industry, they do take customers away. So what happens is the demand curve all the way along starts to shift inwards. Remember we had our average total cost curve when we drew it out before. It looked like this, right? Well, what happens is the demand curve will shift inwards until it is just tangent, as we see here, to the average total cost curve. Notice, though, it's not at a minimum. So the marginal cost and marginal revenue intersection points still determine the quantity of output in the long run, and if we extend it up to the demand curve, that will set our price. It's just now our cost equals our price at this point of the average total cost curve. It's not at a minimum. It is at a higher cost, so they're operating at a higher cost, and the industry is experiencing a lower level of quantity. The big difference between perfect competition and monopolistic competition is that there are costs to being different that are borne by the suppliers in this industry that are not experienced in perfect competition. Advertising and product differentiation costs, so you're not going to get to your minimum efficient scale on the average total cost curve. But at this point in time, since our price is going to be equal to our average cost, our marginal revenue equaling our marginal cost is still the point of maximum profit, but since price equals average cost, our economic profit equals zero. All right, we've got perfect competition and monopolistic competition safely behind us. We have oligopoly and monopoly in front of us. We'll deal with oligopoly now, and we'll look at it along the same 4 dimensions that we looked at the previous 2. We'll start with demand analysis, then we'll cover supply analysis, look at optimal output, and finally long-run equilibrium. So let's start with demand analysis. 2 characteristics of the market structure of oligopoly we should be aware of here. Number 1, high barriers to entry. So we have few firms selling very close substitutes. Number 2, this is the important one, there is some non-price competition going on. So firms do have some pricing power, so we are facing a downward sloping demand curve. Here's the big thing that we have to deal with in oligopoly is we don't just have a well-defined demand curve. It really depends on the pricing decision adopted by the firms, but the pricing decisions are interdependent. What I will do is really dependent on what I think you're going to do. So market demand characteristics depend on the pricing strategy adopted. We're going to look at 3: pricing interdependence, Cournot assumption, and Nash equilibrium. And this assumes that there is no collusion going on between the firms. If we have an oligopoly where the firms are colluding, where there is collusion, we refer to that as a cartel, and all members simply just divide up the aggregate demand curve, and the aggregate demand curve remains the same, and every firm just takes a little piece of it. But we're going to assume that there's no collusion here, so let's have a look at pricing interdependence. All right, this sort of looks confusing, right? But it really isn't. What we're going to do is we're going to look at price at 2 decisions of a firm. One is to raise price, one is to lower price, and we're going to see what happens, and then we're going to combine them. So let's look at our first scenario over here. We're going to raise our prices, but our competitors will not. So remember now, there are very few firms in the industry. We all have very close substitutes. If I raise my prices, I'm going to lose customers, because the best response from the other firms in the industry is to not raise their price. They will get my customers. So I will be facing a highly elastic demand curve if I do that, because any change in price will lead to a large change in quantity. Well, let's jump all the way to the other extreme, and let's say that instead of raising my prices, I'm going to lower my prices. Well, now my competitors follow suit. If I raise my prices, competitors say, you go ahead, we're going to stay right here. But if I lower my prices, my competitors are going to say, oh, no, you don't. Not without me. They're going to follow suit, which means I've got a highly inelastic demand curve, which means I would have to drop my price considerably to get any gains in quantity. So I'm facing 2 possible different types of supply curves. Which one is going to prevail? Well, for that, we're going to need a market price that exists already. So we're going to assume a price level. Let's focus on the middle graph now, and let's say that there's a certain price in the industry, and we'll extend that price both ways across both graphs. So that at this particular price, if I attempt to raise my price above the market price, I will be facing this type of situation. If I attempt to lower my price below the market price, I will be facing this type of situation. So I end up with a kinked demand curve, where the upper part of my demand curve comes from here, and the lower part of my demand curve comes from here. And you're just sliding these 2 together, overlaying them, and this is what you get. You will get a kinked demand curve, but you will get a marginal revenue curve with a gap in it. We will adopt the marginal revenue curve from this situation here, but the marginal revenue curve comes from our second situation where we lower prices. There's a gap. If I draw a marginal cost curve just tangent to this marginal revenue curve, that tells me that my output should be at Q. But at MC3, if I do another marginal cost curve at this marginal revenue curve and make it just tangent, I get the same output. In fact, I can draw marginal cost curves anywhere in this gap, and it wouldn't change anything. I'd have the same output. So here we are. Prices above P will be much more elastic. Prices below P will be much more inelastic. And marginal cost curve 1 to marginal cost curve 3 and any other one that you want to draw in between, potentially many more, do not affect the equilibrium price and quantity output. So here I have to think, if this is a price over here, I have to be very strategic. I have to think, hey, listen, hang on now. If I raise my price, no one else will. And I'll be alone, and I will have a very elastic demand curve. For every small increment in price, I will lose lots of quantity. If I lower my price, my competitors aren't going to let me take their market share away from me. They'll match my price. We'll have a price war, and nobody wins. All right, our second pricing strategy, the Cournot assumption, also assumes that there's no collusion going on. Firms set output simultaneously, and then they let the market determine the price. So they'll make their quantity decision, and then every firm will output the quantity that they've decided to make, and the collective output of all the firms will then determine what the price is. So market price depends on total output. So the big assumption, it's called the Cournot assumption. The assumption is this: each firm will choose its profit maximizing output, assuming, there's the assumption part of it here, assuming the output of the other firms will not change. So I will look at what other firms have done last year, and I'll say, I think they're going to do this year. I will simply choose the output that maximizes my profit, given what's already going on. So let's look at an example here, or at least a little example to walk us through this. So let's assume only two firms, a duopoly, that sell identical products. And we'll ignore this first chart down here. Let's look at the second one over here. And we're going to go to two extremes of the market. We're going to go from monopoly to perfect competition. And we're going to look at firm 1 and firm 2 in the decision they make for quantity. So look at the vertical here. This is firm 1's quantity of output. This is firm 2's quantity of output. So let's start with the monopoly position. Let's assume firm 2 doesn't exist and firm 1 is the only firm in the industry. They will act like a monopoly, and they will have the monopoly output at QM. If firm 1 doesn't exist and there's only firm 2 will have monopoly output at QM as well. Great. Let's go all the way to perfect competition. At perfect competition, each firm will put out the output that corresponds with their marginal revenue curve equaling their marginal cost curve, which will be a higher level of output. So firm 1 will put out its profit maximizing output, and firm 2 will put out its profit maximizing output. Well, these are extremes. The monopoly and the perfect competition are the extreme. We know we're dealing with an oligopoly, so we're somewhere in between here. So this line here represents firm 2's best response to whatever firm 1 is doing, and this line over here represents firm 1's best response to whatever firm 2 is doing. So the intersection of those two lines will be a Cournot equilibrium. And if we need to see it a little more clearly, let's draw some things out. There's perfect competition. There is our price line, which is also our marginal revenue line, which is also our marginal cost line. And let's draw out a monopoly situation. There's our demand curve. There's our marginal revenue curve. We know that this point over here is going to be the output in perfect competition. And we know that this point here is going to be the output in monopoly. So we can see that the output in perfect competition, the decision would be for a greater output. Notice there's no price in here. We're just mapping quantity against quantity, firm against firm. The market will determine the price. Once we figure out what the quantity output is, the market will determine the price. So we know that our output is going to be greater than the monopoly output, but less than the perfect competition output for the industry as a whole. And this is what it looks like over here. So monopoly price is up here. If this is our output for monopoly, this is QM. Notice we have QM and QPC. So this is the quantity from low to high. Here's QM, here's QPC, here's Cournot somewhere in the middle. If we're at QM with a downward sloping demand curve, there's a price, the monopoly price. If it's perfect competition, much greater output, but a much lower price. The Cournot equilibrium is somewhere in the middle. The price will be somewhere between the two prices, and the quantity will be somewhere between the two quantities. That's the big takeaway here. We don't have to worry too much about how the logic of the argument gets there. I think I've done a pretty good job giving you the high-level views. This is your big takeaway here, is that the Cournot equilibrium will place us somewhere between what a pure monopolist would do and an industry that is characterized by perfect competition. All right, I'll walk through a numerical example here. I want to be clear, though, the learning objectives do not have you calculate or interpret anything. So if you want to fast forward through page 9 here, you're not going to really miss anything. Page 9 will just give you a little bit of a deeper understanding as to how we arrive at this Cournot equilibrium and why it is the case that the quantity sits between what a monopoly output would be versus what perfect competition is. So let's begin. Let's say that we have a demand curve 450 minus P, which means our price function, or our inverse demand function, is 450 minus QD. And QD, we're going to split between two firms, Q1 and Q2. So quantity demanded will be the sum of what firm 1 and firm 2 put out. We have a downward sloping demand curve. Both firms face a marginal cost equal to 30. So we can rewrite this P as P equals 450 minus Q1 minus Q2. And we're going to, each firm, remember, is going to maximize its profit. That's the goal, maximize profit. And they do it at the point where marginal cost equals marginal revenue. And we know that marginal revenue is the first derivative of total revenue with respect to quantity. So we're going to need a total revenue curve for each of these firms. So let's take firm 1 and calculate TR1. And it's price times quantity, which equals, well, we're given price down here. So we'll just take 450 minus Q1 minus Q2 multiplied by quantity, and since it's TR1, we're multiplying it by Q1. That'll give us 450 Q1 minus Q1 squared minus Q1 Q2. And we can take a derivative of that. Our marginal revenue curve, which is the derivative of that, is and we're dealing with a partial derivative now because we have Q1 and Q2 in here. So let's make sure that we say that we're taking a partial derivative with respect to, Q1 in this particular case. We will have 450 minus 2Q1 minus Q2. And if we do a total revenue curve for 2, again, it's price times quantity, will equal 450 minus Q1 minus Q2, but this time multiplied by Q2. So 450 Q2 minus Q1 Q2 minus Q2 squared. Our marginal revenue curve 2, again, we're dealing with partial derivatives. That's Q2. Will be, what are we going to have here? 450 minus Q1 minus 2 Q2. So there's our first MR curve. Here's our second marginal revenue curve for each of the two firms. We know our marginal cost is 30, so I think we're in a position now to equate them together. So for firm 1, I'll just write firm 2 over here. The profit maximizing equation would be, we'll take this one over here for firm 1, 450 minus 2Q1 minus Q2 must equal 30. And for firm 2, we're down here. That is 450 minus Q1 minus 2Q2 must equal 30. Well, we can see that these both equal 30. We have 30 here and 30 here, so we can simply just equate them together. 450 minus 2Q1 minus Q2 would equal 450 minus Q1 minus 2Q2. I think you can see the 450s cancel out. We're left with negative 2Q1 minus Q2 equals negative Q1 minus 2Q2. And we'll just bring the Q1 over to this side. We'll add Q1 to this side and add Q2 to this side, and we will end up with negative Q1 equals negative Q2, or Q1 equals Q2. It doesn't have to work out that way. It just so happened we said that both firms have a marginal cost of 30. If they both have the same cost structure, they're both going to make the same output decision. So kind of makes it kind of a little weak, a bit of a weak example here, but we'll take it. So let's finish up. We have 450 minus 2Q1 minus Q1 equals 30. Q1 equals Q2. So what do we have in here? This will just turn into 450 minus, we'll just say 3Q1 equals 30. 3Q1 will equal 420, which means Q1 must be equal to 140. And if Q1 equals 140, let's find out what we have here in terms of quantity demanded. We know Q1 equals Q2. Q1 plus Q2 will be 140 plus 140 equals 280. So the industry will output 280 units at a price of, we said it's 450 minus QD. This is all from up here, by the way, right? Which would be 450 minus 280. We'll get 170. So there's our output and there's our price. To see that the output of 280 is between what a monopoly output would be, let's just calculate what the output would be if it were a monopoly. And if we had a monopoly, what would we have? Well, we'd have price times quantity, but we'd be dealing with the whole demand curve. We'd have 450 QD times quantity. So we'd have 450 QD minus QD squared. So our total revenue curve would be 450 QD minus QD squared, which means our marginal revenue would be 450 minus 2QD, and 2QD would be equal to 420. Why are we saying that? Well, because we're equating marginal revenue with marginal cost. So marginal revenue is 450 minus 2QD. It must equal 30 to be a profit maximizing point. So I've just skipped a few steps and taken 30 off, equated this to 30, then moved the 450 to the other side. So 2QD equals 420. We can see that QD under this situation will equal 210. Notice the monopoly output, 210, is less than the Cournot output of 280. Well, let's do perfect competition now. Perfect competition, and let's see what the output of perfect competition was. At this point, our marginal revenue curve is our demand curve, because remember, in perfect competition, we have a horizontal demand curve. So our marginal revenue is going to be 450 minus QD. Is equal to price. Again, I'll draw that out for you. Our demand curve, our price, is equal to our marginal revenue, is equal to our marginal cost, is equal to our average cost. So 450 minus QD is our marginal revenue, because that's what the price is. So QD, if it equals 30, if marginal revenue has to equals marginal cost at 30, 30 must equal 450 minus QD. It doesn't take much to see that QD must be 420. So the perfect competition output is 420. The Cournot output is 280. The monopolistic output is 210. And if you use these functions over here to find price, you'll find that the monopoly price is the highest, the perfect competition price is the lowest, and Cournot price is in the middle. All right, the last pricing strategy we need to look at is probably the most powerful one, is Nash equilibrium. And what was said, or what John Nash was trying to say when he developed this in the context of game theory, is that markets don't just find the equilibrium that makes everything okay. There are instances where markets can get into an equilibrium that is suboptimal. However, in that equilibrium, no one has an incentive to change their strategy unless everybody changes their strategy. So let's look at a simple example here. A Nash equilibrium is an equilibrium in which no firm obtains a higher payoff. Typically, we say no player obtains a higher payoff, but here we're talking about firms, so we'll just name them. No firm obtains a higher payoff, holding all other firm strategies constant by choosing a different strategy. So here we have ARCO and BATCO, and they can pursue either a low price or a high price strategy. If ARCO pursues a low price strategy, the payoffs are 50 and 80 depending on what BATCO does. We can see that BATCO in this situation says, well, if you're going to pursue a low price strategy, so will we. Because if we go high, we make nothing, so we'll go low. We'd prefer to be down here where prices are high, and ARCO sees the same thing. It says, look, if BATCO chooses low, we can either make 50 or 300. So clearly we'll choose a high price strategy because we'll maximize at 300 instead of 50. If BATCO goes high, well, we'll go high as well. That's our best option. We'd like to see them go high. So ARCO is going to go high no matter what. Whereas BATCO, look what's going on here. If ARCO is low, BATCO can either make 70 or 0. So BATCO will clearly choose low. If ARCO is high, BATCO can either make 350 or 300. So BATCO will choose low. ARCO will choose high, BATCO will choose low, so this becomes the Nash equilibrium. ARCO would rather BATCO take high. but look what happens in this situation. ARCO has no motivation to move. It has a high price strategy. If it moves to a low price strategy, it's going to make 50, BATCO will make 70. That is worse for both. So ARCO is not going to go there. BATCO is not going to take a high price strategy because its payoff will go from 350 down to 300, so it's going to maximize its profit. This is the sell, and these are the strategies, high and high, where industry profitability is maximized. However, here it is not. Here we have 650 versus 800. So in this Nash equilibrium, neither has an incentive to switch. Well, let's move on to an analysis of supply under a market structure of oligopoly. And if we recall, under perfect competition, we derived the supply analysis under that condition. The same applies to oligopoly with a little twist. So let's have a look at what we have here. The level of output will be determined by marginal revenue equaling marginal cost, but price, as we know, is determined by the demand curve. And this is even if one firm is dominant and sets the price. So let's look down here and just see this top curve up here, marginal cost F, and this one here, demand F. Ignore those for now. Pretend they don't even exist. What we have is what we've seen under monopolistic competition. There is the downward sloping demand curve. Here's our marginal revenue curve. There's our marginal cost curve. There's the intersection of marginal revenue and marginal cost, which determines our quantity. Remember, we extended up to the demand curve to determine our price. It's just now, this was the decision made by the leader in the firm. The leader in the industry. So the leader sets the price. The followers follow the price. And this would be the demand curve for the followers. Notice that it is steeper, and here's why. The leader firm, clearly, if you look at the marginal cost schedule for the leader firm versus the follower firms, the leader firm clearly has a cost advantage. So at lower prices, more of the followers would fall out of the industry, hence there'd be significant increases in quantity at lower prices for the leader firm, having a very elastic demand curve at that point. So here we go. Here is the marginal cost schedule. Here's the demand curve. And we would have a different marginal revenue function, but we're not going to put that in. The important thing here is that for the follower firms, price is not determined, the output is not determined by the intersection of their marginal cost and marginal revenue curves. They're going to take the price that's in the industry. That price extends out to wherever the demand function happens to be, which sets the quantity for the total industry. So here we are here with this. We just extend price out to this demand curve. That's total. So the leader will supply this much quantity, and followers will supply the incremental quantity. So this is the quantity for the follower. So this is the total quantity, this is the leader quantity, and the difference is the quantity supplied by the follower. So there is no single supply relationship. Again, like in monopolistic competition, that didn't exist either. It is just a series of points that we would have to graph out first to determine what the supply curve looks like. Let's look at an analysis of output. No single optimal price and output analysis in an oligopolistic market structure. In pricing interdependence, we just arrive at an equilibrium point at the kink. That is our optimal output and price. Under Cournot, we find a Cournot equilibrium. That would be the optimal output and price under that pricing strategy. Under Nash, pricing, a Nash equilibrium pricing strategy, we find the Nash equilibrium point. If the dominant firm is the price leader, marginal revenue equals marginal cost of the leader firm. We'll set the quantity for the leader, and we'll also set the price based on the leader's demand function. All others follow the price of the leader. Long-run equilibrium, long-run economic profits are available. In the long run, they're still available for differentiation. Well, let's move on to our last market structure here, monopoly, and look at demand analysis. Actually, we'll combine supply and demand analysis into one graph. We have seen this before. I introduced this back in monopolistic competition, except now for monopoly, it is the only supplier, period. So we have a single supplier and high barriers to entry. That means there is considerable pricing power. How do we get that? Well, patents, copyrights, control over critical resources, government authorization, things like natural monopolies. Network effects, think of Facebook. Monopolist's demand schedule is the aggregate demand curve in that relevant market. So ignore the pink lines for now, the marginal cost and the average cost lines. Let's ignore those. Here is our demand curve. There is our marginal revenue curve. Now we'll bring in the cost lines. There's our average cost line, our marginal cost line. The intersection of marginal cost and marginal revenue will dictate our quantity. If we move that up to the demand curve, we will find our price. At the intersection here of the average cost curve, there's our costs, which means this area in here is economic profit greater than zero. So, monopolist demand schedule, we've already done that, right? Supply analysis, no well-defined supply function. It is a point. We'll supply this for that price. So there is no supply schedule really, it's more of a supply point. The profit maximizing level of output occurs where marginal revenue equals marginal cost. Again, more like a supply point than a supply curve. All right, one last point before we go. Optimal price. And I know you're thinking that I think we've dealt with that. Here is our marginal cost curve. Here's our marginal revenue curve. That intersection sets our optimal quantity. Extend up to the demand curve. There's our optimal price. But what if we don't have a demand curve? What if we can't just simply draw a line and say, there we go? Well, it turns out there's a relationship between marginal revenue, marginal cost, and the elasticity of demand. If we notice, marginal revenue here is positive, which means as we extend upwards to the demand curve, we'll be in the elastic region of the demand curve. So if we know something about elasticity, would that stand in for demand? And it turns out there is a relationship between marginal revenue and elasticity of demand, and it looks like this. Marginal revenue equals price multiplied by 1 minus 1 over the elasticity, or the price elasticity of demand. And we know that marginal revenue equals marginal cost, so if we know our marginal costs, we can simply substitute that in, 1 minus 1 over elasticity of price, and if we know our price elasticity of demand and we know our marginal cost, it's clear that we should be able to solve for the optimal price given those variables. Well, let's look at long-run equilibrium in a monopoly market structure. And here we're going to introduce the concept of regulation, because the long-run equilibrium position could be a regulated monopoly. So P sub R will be regulated price, Q sub R is regulated output. So let's start with what we've already seen, unregulated monopoly. What will the long run look like? Exactly what we saw on the last screen. Here's our long-run marginal cost curve. Here's the intersection of the long-run marginal cost curve and marginal revenue, which will set the monopolist's output. Bring that up to the demand curve, and that will set the monopolist's price. And if the monopolist can survive without regulation in the long run, that's exactly where they'll stay. If regulation steps in, it can step in two places. It can step in on the long-run average cost curve or the long-run marginal cost curve. So let's deal with the number one here, the marginal cost curve. It could set the price at the long-run marginal cost curve so that the consumer gets a price they would get if perfect competition existed, and then the government would then provide a subsidy to the monopolist back up to a regulated price, which would be on their long-run average cost curve. Not really the popular way to go. Number two is just to price it on the long-run average cost curve to begin with, and just say to the monopolist, that's your price, and you got to work with it. Simple as that. And remember now, these cost curves include the required rate of return, so it's not as if they're saying to the monopolist, you can't make any profit. They're just saying you can't make any excess profit above the risk necessary for investors to provide capital. And they could set there. So it depends on the level of output that the government would like to achieve. If they want a very high level of output, they'll price it in terms of perfect competition, then provide the subsidy, so that the monopolist is still getting the subsidized, the regulated price, which is higher than the competitive price, but output ends up being higher. If they price it on the long-run average cost curve, then the monopolist is still getting the regulated price. However, output tends to be lower. So it depends on how they want to approach it. The final thing that could happen is just, you know what, never mind, let's just nationalize it. And you just have national ownership. And a lot of public services are owned by the government because just of the investment in infrastructure that would be required to build these things out and maintain them. You can't really have competing forces working at it, because nobody would make money. Then if nobody made money, what would happen? Everybody's operating below their shutdown point. Everyone would shut down. There'd be no supply. So some businesses have to be a monopoly only because the market can only handle one firm. We're now on our last two learning objectives, LOSG and H. We're actually really only on LOSG. LOSH was already done as LOSA, so let me clear that up first. H says identify the type of market structure within which a firm operates. Well, if you go back to A said to describe characteristics of perfect competition, monopolistic competition, oligopoly, and pure monopoly. And we did so along 5 dimensions. Well, that's H. So for H, all we have to do, instead of identifying the characteristics, we would just start backwards. We would be given characteristics and identify the market structure. So it's just going back to LOSA and saying, instead of looking at the dimensions and looking at the characteristics of the industry, I'll start with the characteristics and just identify the market structure. So let's do LOSG. Describe the use and limitations of concentration measures in identifying market structure, and we'll look at a concentration ratio and the HHI, the Herfindahl-Hirschman index. So the concentration ratio is really just the sum of the market share of the n largest firms. So if you say, well, give me the 5 largest firms in this industry, what's the concentration ratio? And that'll range somewhere between 0 and 100%. I can't really see it ranging as low as 0, simply because if you have the 5 largest firms, it can't possibly be 0, right? But anyways, as it approaches 0, we could say that the industry appears to be characterized by perfect competition. As it approaches 100%, we would say, well, it appears to be characterized by oligopoly or monopoly. The concentration ratio will quantify size, but not market power. You could have a situation where you have 5 firms that make up 50% of the industry, but firm 1 represents 40% of that. Which has significant power. So that's not captured by this concentration ratio. And it may be unaffected by M&A among the top-end firms, which means that firm 1 and firm 2 can consolidate. And if you were doing a concentration ratio, the concentration may not change, because you'd be adding the 6th firm would suddenly become the 5th firm, but the 6th firm might be so small that it doesn't change the concentration ratio at all. So you're saying, well, if firm 1 and firm 2 merge, since it doesn't really change the concentration ratio, we can't see that it's consolidating market power. Off it goes. The Herfindahl-Hirschman index, HHI. It is like the concentration ratio, except we square the market share first. So it's the sum of the market share squared of the n largest firms. If it equals 1, we have a monopoly. It can get as low as 1 over m, where m is just the number of firms with equal market share. So 10 suppliers, each with 10% market share. If we ran it through the HHI, it would be 0.1 squared plus 0.1 squared 10 times. You'd end up with 0.1. 1 over 10 is 0.1. If we wanted the HHI in this particular case for the 4 largest firms, well, there are no 4 largest. They all have equal market share. It would just be 0.1 squared 4 times. You'd end up with 0.04. Again, the closer this approaches to 100%, the more concentrated the industry is. So at this point, we would say, well, it doesn't look like a very concentrated industry at all. Now, the limitations of the HHI index, it does not take the possibility of entry into account, so that you may have a concentrated industry, but the barriers to entry may be so low that those in the industry will act as if there is extra competition, because the possibility of it is always there. Further, it does not consider the elasticity of demand.